Welcome, everyone. Today, we're diving into the ultimate high-yield revision session for ACCA Financial Accounting. If you are looking to absolutely crush this exam, well, you're exactly where you need to be. In this explainer, we're going to break down the examiner's gauntlet together, pulling out the exact traps and high-yield summaries you need for those crucial last-day revisions.
So, I have to ask, are you ready to conquer the absolute hardest parts of ACCA FA? Because honestly, we aren't just going over the basics today. We're stepping right onto the battleground to tackle the exact areas where students tend to lose the most marks.
Here's our agenda for today. First up, prepping financial statements. Second, partnership accounts. Third, limited company equity. And finally, the notorious cash flow statement. Let's jump right in. Battleground 1, prepping financial statements. This is really the core of the exam, where you take a raw trial balance and turn it into perfect balancing statements.
To survive this part of the exam, you need a strict step-by-step flow. First, identify your adjustments, things like accruals or depreciation. Second, get them straight into a working schedule. Third, draft the income statement to find your profit, which naturally leads to step 4, your statement of financial position. And finally, the moment of truth, ensuring that balance sheet actually balances. Sticking to this exact sequence is how you keep your head clear when the pressure is on.
Keep in mind, every single adjustment in your schedule has a dual effect. One on the profit and loss, and one on the statement of financial position. Think about it. An accrued expense hits your P&L as a cost, right? But it also sits on your SFP as a current liability because you still owe it. Meanwhile, depreciation increases your expenses while simultaneously dragging down the value of your non-current assets. You really have to track both sides at the same time.
And that brings us to a massive exam trop alert. I literally cannot tell you how many students mix this up. An accrual means you owe money. It is a liability. A prepayment means you paid in advance. It's an asset. Please do not let the examiner catch you swapping these around.
So, if you're going to lock anything into your memory today, make it this one-line summary. Adjustments affect both P&L and SFP. Track both. If you only adjust one statement, your balance sheet is never going to balance.
All right, moving on to Battleground 2, partnership accounts. The rules change just a bit when we step away from a sole trader.
With partnerships, the absolute key concept you must grasp is the appropriation account. This is a special account used strictly to show the distribution of profit between the partners. It's like the mechanics of how they slice up the profit pie they just baked together.
And the order in which you slice that pie, absolutely critical. You don't just split it down the middle right off the bat. No, first, you pull out salaries for the partners. Next, you pull out interest on their capital and account for interest on their drawings. Only after all those specific prior agreements are settled do you take the remaining residual profit and split it according to their agreed ratio. That residual ratio is strictly applied last. To instantly recall this when you're under exam pressure, just repeat this one-liner to yourself. Partnership appropriation equals salary, interest, then residual and ratio. Keep that rhythm in your head and you won't get lost in the calculations.
Next up, Battleground 3, limited company equity. This is where things get a bit more corporate, and the examiner loves testing your grip on share capital and reserves. First off, we need to quickly delineate between the types of shares. Ordinary shares give you voting rights and a variable residual dividend. These guys are the true risk takers of the company. On the flip side, preference shares give you a fixed dividend and priority over the ordinary shareholders when it comes to getting paid. You have to know the difference. Next, let's map out the reserves. Your share premium is simply the excess cash you receive over the nominal value of the shares. Then you have the revaluation reserve, which is born entirely from asset value gains. Retained earnings represent your cumulative, hard-earned profits minus any dividends paid out. And finally, a general reserve is really just a safekeeping transfer from those retained earnings.
But wait, hold on. Exam trap alert. The examiner will absolutely try to trick you into paying a dividend out of the revaluation reserve. You cannot do this. A revaluation reserve represents an unrealized profit. You haven't actually sold the asset yet, so you don't actually have the cash to distribute. Never, ever distribute from a revaluation reserve.
Lock this rule in. Reserves equal retained and other non-distributable. Always categorize them in your mind. Ask yourself, is it distributable like retained earnings, or non-distributable like a share premium or a revaluation reserve? And now we enter the final and notoriously trickiest level, Battleground 4, the cash flow statement under IAS 7. IAS 7 requires you to strictly separate your cash flows into 3 very distinct buckets. First, operating activities. This is the lifeblood, your everyday trading cash. Then you have investing activities, which handles buying or selling non-current assets. Finally, financing activities, covering the capital structure, things like issuing shares, taking loans, or paying dividends. Make sure you don't mix these up.
Now, the real lifesaver here is the indirect method shortcut for operating activities. Instead of trying to count every single cash receipt, you just work backward. You start with your profit before tax. Then, strip out the non-cash illusions by adding back things like depreciation. Next, adjust for the reality of your working capital, so changes in inventory, receivables, and payables. Finally, deduct the cold, hard cash you actually paid for tax and interest. This is the exact journey the examiner wants to see you take.
But be incredibly careful here. Another exam trap alert. Working capital changes trip literally everyone up because the logic feels backwards. Think about it. If your receivables increase, that means your customers haven't paid you yet. Your cash is tied up. Therefore, an increase in receivables is a cash outflow. You must subtract it.
So the crucial point to anchor this whole topic is simply cash flow equals operating plus investing plus financing. Keep your profit adjusted for non-cash items, carefully track your working capital logic, and just make sure to place everything in the right bucket.
Okay, we have made it through the gauntlet. But before we wrap up this explainer, I need to share the ultimate exam rule. Show all your workings. Seriously, method marks will save you. In a computer-based exam, even if your final balance sheet is off by a few dollars or your cash flow doesn't perfectly tie out, you can still easily pass. The examiner awards method marks for every single correct step. If you just type a final wrong number into a cell, you get a 0. But if you show the equation, you get the points for the parts you did right, and that can completely save your grade. So, you have the formulas, you know the traps, you understand the structure. The only question left is, are you ready to execute? Don't just stare at your notes. Open up a blank spreadsheet or a practice platform right now and start doing the reps. Good luck, and go crush that exam.